Hey guys, welcome back to another Monday's video where we talk about my TFSA portfolio as well as some stock market news. In today's video, we're going to be talking about my favorite ETF in my TFSA portfolio and why I believe in the future it will continue to outpace the general market. At the end of this video, as usual, we'll be doing a quick update on what happened this past week, what stocks I bought, and how the portfolio is doing. Before we move on, I want to say thank you to those of you guys who have stuck around, watched my content, and continue to help me out by smashing the like button. And if you guys want to get more resources from me, you can check out the Patreon group where I provide buy and sell alerts for my Wealthsimple Trade account and Questrade. You'll also have total access to the spreadsheet that I feature in this video, and you'll also get up-to-date stock market thoughts and which stocks I'm looking at buying next before I even purchase them. I also have a course on how to create a spreadsheet if that's all you're interested in. It's completely free with a Skillshare trial, and links for both of these are in the description down below. Now let's jump over to my computer, talk through some research I've done, and I'll explain to you guys which ETF this is. So the ETF that I'm the most bullish on in my portfolio is HXQ. This is the Horizons Nasdaq 100 Index ETF. This ETF just had a 2-for-1 stock split on July 2nd. So if you guys saw the price of HXQ basically get cut in half, you should have also noticed the number of shares that you own. If you own this ETF, they actually doubled. This ETF predominantly holds technology stocks, which is what the Nasdaq is made of. If we look at the holdings, the top 10 holdings, we have companies like Apple, Microsoft, Amazon, Facebook, Tesla, Google, Nvidia, PayPal, and Adobe. They have 11% in Apple and 9.812% in Microsoft. The top 4 holdings make up just over 30% of the portfolio. And then the top 10 holdings make up just over 40%. So this is a very tech-heavy ETF. And the reason why I do believe technology is the future is because of the next thing I'm going to talk about here. First off, looking at Canada, we can see that hiring intentions are going to hit an all-time high in the survey done by the Bank of Canada. So because the economy is opening up and there's a lot less restrictions in Canada in the near future, we're going to see businesses start to flourish because people are going to be able to go out there and spend money. And as people spend money, businesses are going to earn money, and those businesses will spend money with other businesses, and the whole cycle continues as value is created. And as value is created, I guess employees' wages will ultimately go up even more, and more people will get jobs. And then this is sort of like a self-fulfilling prophecy where the economy grows bigger and bigger and bigger. But one thing that might be stifling this is labor shortages. And I think that there's a lot of people who are considering quitting their jobs or maybe changing what they do. So with labor shortages, we might not be able to see the demand for products or services when the economy reopens to be able to be serviced. Because consumers right now, they expect to spend just over 1/3 of their excess savings in the next 12 months, mostly on going out to restaurants and social activities. And if restaurants can't hire enough workers, then they're going to either have to boost wages for these workers, or they're going to have to limit the number of customers they can serve, and therefore maybe prices will go up because there's a supply and demand problem there. There's also going to be people putting their funds into a down payment for a condo or a house. So looking at this, maybe looking into REITs that hold apartment buildings or just residential living spaces is a decent play in the short term. However, looking at office spaces is probably not where you want to go because 4/5 of the respondents to the survey who work from home during the pandemic expect to be able to continue to do so. So businesses are going to have a lower demand for office space, but this is going to turn around into the housing market where the average person is going to demand more space. The one question that you have right now in your head is, why are there more labor shortages? Like, aren't there a lot of people who are out of work? Don't they want to go back to work and start earning a wage? Well, I think that people are realizing that life is more than money. Maybe there's a lot of people who are working just these minimum wage jobs, but they were okay to retire. So there's people in that bucket. Then there's also people who work these minimum wage jobs, got laid off, and decided to take some online courses, boosted up their skills, and now they're more employable at maybe like a software development company. And they're earning a lot higher of a wage versus the minimum wage job that they used to work. And with these labor shortages, businesses are going to have to cope somehow. And the best way that I can see them coping with this is through technology. And that's where the ETF HXQ comes in. because technology can replace a lot of activities that can be done through software or through hardware or through robots. And people and businesses won't need to hire people to do those jobs. So for example, if you're looking at a company like Shopify, they have a lot of integrations where maybe a business who is in retail used to have to hire someone to do some data entry or to look over receipts and do accounting like that. However, on Shopify's platform, a lot of that is automated already, and they also give you fancy reports where the business owner can see how their business is doing. So I think with technology, companies are also able to deal with the labor shortages. And those who have labor shortages are going to have to adapt and find technology that will help them weather through the labor shortage market right now. And on top of these labor shortages in the minimum wage job sector, we can see that 1/3 of millennials plan to quit their jobs after the pandemic. And the reason is because 80% of the 26 workers who expect to change jobs are concerned about their career growth. And this is the number one thing that it seems like amongst millennials right now is, where am I headed next in my career? And on top of career growth, there's also the aspect of company culture, where when you're working at home and you don't see your employees, I think that company culture is easy to fizzle away. There's no longer socials or water cooler conversations where you can get to know your coworkers. And a job is just, you could do the same thing elsewhere at a different company that maybe pays a bit more. So we're going to see a lot of turmoil in the job market. And thinking from the business owner's perspective, the last thing they want to see is high turnover in their employees. Because that means they're going to have to go out, spend some money to attract new talent, train them up for 3 to 4 months, and hopefully they're a good fit with the company. So there's a lot of risk when an employee leaves and they have to go looking for a new employee. But as I said before, the alternative way to this is to streamline mundane tasks through software or through robotics or through technology. And maybe moving workers around to put them in more higher value areas where it requires a real human interaction. This isn't the only article written about millennials who plan to quit their jobs after the pandemic. There's also this one here: before you join the Great Resignation and quit your job, here's what you need to know. So there's already the term, the Great Resignation, happening. So there's a lot of expectation the labor markets are going to be shooken up. Another article here: if you plan to quit during the Great Resignation, here's what career experts say you need to do. And for companies that do not yet have technology that can take over a regular worker's role, like McDonald's for example, they're raising the minimum wage. They plan to reach an average minimum wage of about $15 per hour by 2024 at all company-owned restaurants. Competitions for workers is intense, and food franchises like McDonald's and Chipotle are competing with retailers like Amazon, Walmart, and Target. So for companies like McDonald's, Chipotle, Amazon, Walmart, and Target who have jobs that can't be replaced by software or by robots, they're having to increase their minimum wage by $15 an hour. However, this is going to spur on technology development to replace these minimum wage jobs even quicker, because $15 an hour is quite painful when minimum wage maybe like 5 or 10 years ago was around $7 an hour. So these corporations that are well off are able to increase their minimum wage in the short term. However, I'll bet you they are looking for technology solutions that can replace humans, because technology never takes sick days. You don't have to pay an hourly wage or benefits, as well as there's no emotional problems from technology because technology is emotionless, unless they somehow get AI and form relationships like humans and have robot drama. But honestly, I don't think that's really a worry for us. So with all that being said, HXQ is definitely my favorite ETF in my TFSA portfolio, just because of the labor shortages and how technology can help battle that, as well as technology is the future. If you look at what technology is doing, it's creating more efficiencies for our everyday lives, it's making our quality of life better as well, and it's pumping out more value than we could have ever imagined in society. All right, now jumping over to my TFSA portfolio. So here you can see I'm up 1.37%. So this percentage is growing quite rapidly. Last week I was only up like 0.85%. So I gained about 0.5% in 1 week. So I'm coming for the TSX index. I'm only down about 4.32% against the index since I started this on March 16th. Right now the total value of the portfolio is just over $5,300. If we look at what I bought last week, we can see that I started buying Sun Life at the beginning of the week. I bought 2 shares for $63.20 each. The reason I continue to add to Sun Life is because I believe Sun Life is moving to more of a digital company, and I think they're a bit more innovative than Manulife. I also received 2 dividends on the 8th of July, one from the Vanguard ETF of the S&P 500 for 26 cents. In RioCan, I got an 80-cent dividend. Then I bought some more RioCan on the exact same day. I bought 3 shares for $22.40. I also bought 1 share of Air Canada for $25.75. And lastly, I had a DCM limit order fill, 20 shares for $1.35. Looking at the entire portfolio, these are the positions that I hold. If we sort them by the market value, we can see that the Enghouse is currently my highest value position, followed by Kinaxis, then Power Corp of Canada, and then Sun Life now. In terms of the positions that I'm up on the most, so far I've made the most on Kinaxis, then RioCan, surprisingly, as it's continued to go up. I think RioCan pre-pandemic was trading at around $27, so that's sort of the price target that I have for RioCan as the entire economy reopens. Although their real estate is geared towards corporations or enterprises, they have some very high quality real estate where it's desirable for businesses to rent out. The third stock with the highest gains is my favorite ETF, the HXQ, and I'm up 10.19%. So for this following week, I think the stocks that I'm going to be adding, I'll probably add more HXQ because currently it's not too high of a percentage in my portfolio, only 5.9%. So I'll probably try to build this to about 7 or 8% in the long run. On top of that, I'll probably look for more opportunities to add to my DCM position, but again, I'm doing this very slowly, about 20 shares at a time. On top of that, I plan to add to my TD position as its price has come down from $87 to $84.70 on Friday. It pays a nice dividend of 3.63%, and TD continues to increase their dividend every single year. Now jumping over to some of the comments in last week's video. So from Joseph, he's wondering if I could do a video on H2O Innovations. They're doing amazing numbers, like really amazing numbers, but their stock is just losing money. So I think, I haven't looked in depth here, but I think for H2O Innovations, it was a pretty high flying penny stock. And for that reason, I think the expectations were a little bit too high for the company, and therefore we're seeing a pullback in the price. Even though the numbers are amazing, maybe they're doubling the revenue or so. However, if you look at the business as a whole and the valuations, the valuation is still relatively rich, as the PS ratio maybe doesn't make sense for investors, and people might see a better place to put their money rather than H2O Innovations, and that's why we're seeing a sell-off possibly. There's a lot of comments about needing a video on Converge Technology Solutions, so hopefully I'll have one out for you guys in the next couple of weeks. A comment from Jerry at the end, he says, a Canadian dividend aristocrat, Key, or Kiera Corp, shows good growth and pays a monthly dividend of 16 cents per share. What are your thoughts? So looking at Kiera, it's one of the largest mainstream oil and gas operators in Canada. And personally, I'm not a big fan of oil and gas, and I know that it recently had a massive bull run just because of how beat down it was. So it's up about 171%. Potentially there's a bit more upside just based on looking at the stock chart and not knowing too much about the oil and gas industry, but I think it's returning to, I guess, pre-pandemic prices. But in the long run, I don't know if there's a good future for oil and gas. I think that the demand for oil and gas, like the heydays for that, are over now. We're seeing continual technology development where oil and gas is being used more efficiently, as well as people are moving away from these fuel sources to renewable energies. But again, there is also demand for oil and gas because we just can't get enough of it as it provides us such great conveniences. So with Kiera, I think that for the short term, getting a 5.8% dividend, it may not be a bad play to hold, and maybe doing a short, maybe 1 year swing trade where you might see about a 10% appreciation in these shares beyond that. But for the long term, I don't think this is a great hold personally. But I honestly could be wrong about that. That's just my personal opinion. Now there's a comment from Bryce saying, what do you use to graph all your investments at the end of the video? If you're talking about that spreadsheet that I use, this is on Google Sheets. And if you see the little graphs that I have here, it's a formula that I use to get these graphs pulled from Google Finance. If you're talking about the stock charts that I use, I typically use Yahoo Finance for graphing stocks and doing some technical analysis there. Thanks once again for joining me on this Monday and reviewing my TFSA portfolio. I'll be putting 2 videos on the screen. If you're interested in those, I'll see you there. If not, keep up the grind and have a great day.